You can't trust the pre-approval that your loan officer is telling you that you're approved for when you go to purchase a home. That's what we're going to be talking about in this home finance hacks. So let's jump right on into it. When you get pre-approved to purchase a home, most people are looking at how much home can I afford? They want to say, oh, your loan officer may tell you you're approved for a $300,000 home. You're approved for a $500,000 home. Whatever that number is, you can't trust that number. And the reason is because you are pre-approved for a monthly payment, not a purchase price. You are pre-approved for, let's just say, a $2,000 a month monthly payment. However, homes aren't sold in monthly payments. They're sold at a purchase price. And so what a loan officer is trying to do is they're trying to take what that monthly payment is that you're pre-approved for and determine about how much home can you purchase or can you afford for that monthly payment. So let's say if it's $2,000, they're looking at that $2,000 a month monthly payment and they're saying, hey, I think that, based on what I think everything that goes in the mortgage payment, perhaps you can afford a $300,000 home. So they tell you you're approved for $300,000 and you go and you find a $300,000 home, you bring it back to them and you think that you can get approved for it. Not necessarily. And so the reason is because there are about 4, sometimes 5 different factors, elements, things that are being factored into your monthly payment. And 2 or 3 of those 4 or 5 are estimates. The loan officer doesn't know. And so because of that, that's going to affect how accurate that loan officer is actually going to be with telling you what you're pre-approved for. So for example, not every $300,000 home has the same monthly payment. Not every $400,000 or $500,000, whatever your pre-approval amount that you've been told you were pre-approved for, assuming you've been out shopping for homes and everything, it doesn't all have the same monthly payment. So for example, you find one $300,000 home that's near the city, and the taxes might be different. The homeowner's insurance might be different. Maybe that home that you found is sitting in a neighborhood that has a homeowner's association fee. I've got a story about that one in just a moment. That home might be more expensive than another home that maybe is in the suburbs or a little bit further out of the suburbs, maybe a little bit closer to a rural area. Still a $300,000 home, but maybe it doesn't sit in a homeowners association. Maybe there are lower taxes in the area. Maybe the homeowner's insurance is not quite as high. Those are some of the things that say, oh, even though both of these homes are $300,000, the one that's in the city, you're going to end up paying more in a monthly payment for, because maybe you have to pay city taxes in addition to county taxes, in addition to higher homeowners insurance, in addition to a homeowners association fee. And then now in the country home, we'll say you have lower taxes. You have no homeowners association dues that you have to pay. You have lower homeowners insurance. Those are some of the things that are going to make the difference between the monthly payment for 2 homes that are the same purchase price. So getting to the story I was going to tell you, there was a lady who was looking at homes. She was approved for about $350,000. She went out looking for $350,000 homes. And she found one that she liked, went back to her loan officer and said, hey, found a home, got under contract. This is the home I want to purchase. Loan officer gets to work on getting the financing, digs a little bit deeper into the details, finds out, oh, you know what? You don't qualify for this home. She says, why don't I qualify? You said I could qualify for up to $350,000. The actual home that she found was around $340,000. Why is it that I don't qualify? You said I could go up to $350,000. Well, I wasn't calculating that you were going to have a $600 a month homeowners association fee. If that sounds high, just come to Atlanta and look at some of the condos in downtown Atlanta. Some of those $300,000, $400,000 condos have $600 a month homeowners association or condo association fees. Is ridiculous. But in any case, the lady decided she wanted to purchase a condo downtown, and that condo came with a $600 a month homeowner or condo association fee. Well, that's not something that this loan officer factored into their estimate when they were telling them how much they could qualify for. So in essence, this individual did not qualify to be able to purchase a $350,000 condo with a $600 a month condo association fee. They could purchase maybe a $250,000 condo with a $600 a month condo association fee, but not a $350,000 condo. So you can kind of see, like, the higher those fees go, the lower your purchase price is. So that's one of the things. So another thing that I will say really quick is that some loan officers suck. They're bad at their jobs. And what I mean by that is, well, what I said, they suck. But to get a little bit more specific, you have some loan officers that care more about the transaction. They care more about originating your loan and getting a check based off of being your loan officer that's going to close on your deal than they care about you. And then they care about you actually getting accurate information that's going to better direct your decision to something that's going to fit into your financial plans. So you have some loan officers that will tell you, oh, you qualify for 400,000, you qualify for 500,000. Really, you don't qualify for that much, but what they want to do is they want to tell you what you want to hear so that you'll get under contract with them. And then after you're under contract, then they start digging in the details and seeing if they can make it work. And if they can make it work, great. But if they can't make it work, it's like, oh, you know what? Sorry, you actually don't qualify, so can't get you this home. And then it's on to the next for them, not realizing how much that can actually disrupt your life, because maybe you were making plans to move out of your apartment. Maybe you had already started the move out process. Maybe you already communicated to the leasing office that you weren't going to renew, and they've already filled your apartment with someone else that's going to be moving in a month and a half or 2 months. So you don't have another place to go right now, or another place to live, or you're going to have to find another apartment, all because you got inaccurate information from a loan officer who cared more about the transaction than they cared about you. Now, I'm not saying that's every loan officer, but there are a number of loan officers out there who do just care more about the transaction. And so they will tell you things like, oh, you're qualified for this high amount, but you're really not qualified for it. They'll tell you things like, oh, you can do this, but you really can't. And so those are some of the things that you just need to, I say you need to be aware of. It's really going to be hard if you don't know how your pre-approvals and everything are calculated. And I have videos that explain how you can really determine based on your income about where your pre-approval should fall. So if I don't remember the exact titles off the top of my head, but I have created videos on that. They are on my channel. So if you spend enough time just looking through some videos on my channel, you'll not only get some really great content, but eventually you are going to come across those videos because it's in more than just one video. But in any case, that's the first thing. You have some loan officers that just suck at their jobs. They're bad. But then the other thing is that loan officers know that you're going to be shopping around with other lenders. So you might go to one loan officer, but you're also going to call maybe 2 or 3 other loan officers. And you're going to see, hey, who can pre-approve me for the highest amount? Knowing that if one says we can pre-approve you for 300, another one says 325, another one says 350, you might just naturally say, oh, I'm going to go with the one that can approve me for 350. That person who said I can approve you for 350 may actually be able to approve you for 350, or they may have approved you at the very top of the budget. But if you happen to get a home that falls, that has higher homeowners insurance or higher whatever else, then that might knock you out of the pre-approval and you don't actually qualify for 350. So there's so many different factors. So let's go over a couple of those really quick. 2 things that every loan officer should know without a doubt that's going to be factored into your mortgage is your principal and interest payments, because that's literally how much money you're borrowing and the interest rate that you're paying on that money. So every $300,000 loan amortized over 30 years at 7% will get you the same answer for every single loan officer out there. If you have 1 or 2 loan officers that are giving you a different answer, you need to stay far away from them because they can't do math. But when you amortize $300,000 at 7% over 30 years, you will get the same principal and interest payment. Now, what loan officers are going to have to estimate, they're having to estimate how much your property taxes are, they're having to estimate how much your insurance is, and they're having to estimate whether or not you're going to be paying homeowners insurance. And if they do estimate homeowners association fees, they're having to estimate whether or not you're going to have to pay HOA dues. And if you do have to pay a homeowners association dues or homeowners association fees, they're estimating how much you're actually going to have to pay. Is it $60 a month? Is it $200 a month? How much is it that you're going to have to pay to a homeowners association? Because that has to be factored into your mortgage payment as well. Some loan officers will factor it or will calculate it. Some loan officers don't even calculate homeowners association dues. They calculate your pre-approval based off of you purchasing a home that doesn't have homeowners association dues. So there are so many factors involved. And like I said, at least half of all the factors that are going into your mortgage payment are estimates. Taxes and insurance, those are going into every single home that you finance, and those are going to be estimates. And homeowners associations, assuming that they estimate that, is going to be an estimate too. So loan officers, in knowing that you are going to be shopping around, they don't want to pre-approve you too low, but they also don't want to give you to the tippy top, because people don't stick to their budget. If you tell someone, and trust me, I've got over 17 years as a licensed real estate agent. I've got a couple years as a licensed loan officer. I have seen it happen time and time again. If you tell someone that they're pre-approved for a certain amount, they're going to look for homes that are higher than that. And then they're going to come back and say, can I get this? Because you tell someone, hey, you're approved for a $400,000 home. They come back and say, hey, I found this home for $415,000. Can I get it? It's like, no one can stay under their budget, and I get it. As a nation, we suck pretty much at budgeting. As a nation, there are a lot of good things that we have. There are some things that we don't do quite as well. Budgeting is one of those things that we don't do quite as well. I mean, think about it. Most Americans don't have a budget. You might be one of those people that don't have a budget. Do you actually budget the amount of income that comes into your house? Do you know how much comes in? And then do you have it designated? This much goes toward groceries. This much goes toward utilities. This much goes toward entertainment. Do you know before you get the money how much of it's going everywhere? You have it budgeted. Or with the money that comes in, do you see the check once it comes in? If you don't get a salary job where you have the same amount that comes in every month, maybe you are paid self-employed, and so that amount changes. But when it does come in, do you designate, okay, this much is going toward tithes and offerings at the church, this much goes toward paying utilities, this much goes to rent, this much goes toward entertainment? A lot of people don't do that stuff. And so when it comes to budgeting, we're not that great at it, and we could do a much better job of it. But because of that, a lot of loan officers, what they will do, they look at what they know they can get you qualified for, and they back it off a little bit. So let's say you can get qualified for that $400,000 home. They're not going to tell you, oh, we can get you qualified for $400,000. They're going to say, we can qualify you at $375, $380. And they back it off a little bit to give themselves some wiggle room. So when you do go and find that, hey, I found this $395, can I get it? And then they go and run the numbers, and it's like, yep, we can get you that house. Or you find the home for $375, but it's in a higher tax part of town that has higher taxes, or it's in an area that has higher that your homeowner's insurance is going to be higher. And there are a lot of factors that affect how much you pay in homeowner's insurance. It's not just the house itself. It's also how many claims have been filed recently. That's going to affect how many homeowners insurance claims have been filed. That's going to affect how much your homeowners insurance is going to be. What's your credit score? Because when you go to get homeowners insurance, they're doing a soft pull on your credit, and they're seeing how well you manage debt and everything. And so that's also going to factor how much you pay in homeowners insurance. And so all of these factors are coming into play. And so maybe your homeowner's insurance ends up being more than what they initially thought it was going to be, but that gives them a little bit of wiggle room to know that, hey, we can still qualify you for this house. So they're not going to approve you at the very top of your budget. That doesn't mean go above that. That means it's giving them a little bit of wiggle room, because you might find that house that you need that wiggle room. And if they tell you $400,000 and you go get a $400,000 home, but you get the $400,000 with the higher taxes, the higher homeowners insurance, the higher homeowners association dues, you don't qualify for that $400,000. So they tell you $375, you get the $375 with the higher taxes, higher homeowners insurance, higher homeowners association dues, and you can still qualify because your actual top of your budget with the estimates that they provided was $400. So hopefully that paints a clearer picture in terms of why what a mortgage loan officer may be telling you you qualify for is not actually what you may qualify for. So you really can't trust those numbers and take them to the bank per se. Now, you have some loan officers that will shoot well under what you actually qualify for. You have some individuals, some home buyers who are very frugal and very conscious about the money that they're spending on certain things. And so they may be approved for $400,000, but they say, I don't want a home that's anywhere near 400. I want the $300,000 home. And they self-impose the restrictions on how much they're going to get that's well below what they actually could qualify for. And that's good as well. There's nothing wrong with purchasing a home that is below your means. That is actually going to give you more disposable income that you can put towards other things. Maybe you can put it towards investing it and growing it in other areas. Maybe you can put it towards starting or growing and building that business that you really want to have, which is going to set you free from your 9-to-5 that you're working right now. So there's nothing wrong with getting that home that's a little bit lower than what your actual mortgage payments are. So just keep that in mind as well. But that's what I have for you. Hopefully it's been enlightening in knowing what you can't trust, but also knowing how all of these different factors come into play to help you get a home as well. So that's what I have for you. Thank you for taking the time to tune in. Take care. Be blessed. We'll see you next Tuesday.